Good morning, ladies and gentlemen. By my calculations, the risk dial is getting more and more positive each week, suggesting to prefer equities over bonds. And it would be interesting to see why that is, to examine what the various landing scenarios that we are trying to assign probabilities to at the moment is. So without further ado, let's have a look at that before we look at the consequences of what CPI number is going to do to the bond yield curve, because I think that is going to be the only thing that changes massively next week. This is a slide that I prepared for two grey beards, but it's relevant for us too. And these are the three scenarios that we are trying to assign probabilities to since the beginning of the year. The hard landing, the soft landing, and what I call the no landing, but other people have called higher for longer, or the big flip. So these are the three possibilities that we have in front of us, and we're trying to assign probabilities to them, and the market and the yield curve is responding to them. Hard landing is the easiest and the most obvious one for how assets perform, because in a hard landing, basically you sell equities and commodities and you buy bonds. This at the moment is becoming the least likely outcome in the immediate future, and that is what the market is pricing. Although leading indicators and some real economic data, forward-looking economic data, are anticipating this scenario, we are actually transitioning to these two scenarios at the moment. The soft landing is one of immaculate disinflation, as I've termed it, and that is a scenario in which the economy stays relatively strong, employment is relatively good, but we don't get the second round transmissions of inflation, i.e. we don't get higher wages or higher wages demands, and basically the economy struggles through, nothing too warm, nothing too hot, nothing too bad on the downside, and really what happens is that inflation falls all by itself down towards the 2% Fed target. Nothing else changes, and then the Fed can declare victory. And what do you get? You get equities going up, you get commodities going up with equities, most probably. This could have been a sideways sign, but it's more logical that they should go up slightly. And bonds do nothing but change the shape of the yield curve, because let's face it, why would the Fed keep rates at a terminal rate of 5% if inflation is down at 2%? What's likely to happen is that slowly the Fed starts cutting rate towards, let's say, a 2.5% Fed funds rate. And what do the 30s do? Well, the 30s don't change very much. They go down to 3.25%, maybe 3%. But you get a flat to positive yield curve, and that means that at the long end the bonds don't change all that much. I could have said up, but it's more likely to be sideways, with the yield curve taking the bulk of the strain. Now, the last landing is what people have termed the big flip, higher for longer, or whatever you like to call it, and that means a hot economy, but with inflation not either ripping or not ripping. It doesn't really make much difference, but remaining sticky at the very least. By sticky, I mean it gets down to maybe 3%, but it doesn't get any lower than that. The Fed is not happy. and it has to continue tightening until it gets inflation down into the twos at the very, very least. The market is beginning to assign more and more probability to this scenario. And therefore, what would be the consequences for that scenario? The real consequences are going to be in the bond yield curve, which is going to get more and more and more inverted. What are equities going to do? I could have said sideways for equities because the multiplier is going to go down, but certainly earnings are going to remain decent, good, i.e. we will not get earnings below 200. We will get earnings in the, I know, certainly above 200, maybe even above 225. But the multiplier should certainly go down with the bonds. And then, therefore, equities remain in a volatile range, but are capped. But certainly, every time they get down, they get bid back up. Commodities should do well in that environment, so that's why I put them first. So these are in order of performance that I would expect under the different scenarios. Whether, equities go slightly down with bonds, but certainly they will perform better than bonds. So you're getting the idea. This scenario is getting bid up, this scenario is getting sold, and this scenario is going sideways to getting sold. To me, this scenario absolutely ensures this scenario at some stage. Not now, not maybe for quarters, certainly months, possibly quarters. But this scenario inevitably leads to this scenario, because the terminal rate will change. The terminal rate will get into the fives, possibly even into the sixes, if the Fed really gets pissed off with inflation at 3.5. It completely depends where it is sticky. If it's sticky at 4, we're going into the sixes. If it's sticky at 3, we're going into the fives. So you get the idea. This is what the market is trying to assign probabilities to. And it's, funnily enough, it's a battle that's going to rage for months. It's not something that's going to be decided very quickly, and it's certainly not something that's going to be decided by one CPI number, whatever it happens to be. And therefore, the only thing that's really likely to change in a big way next week is the shape of the yield curve. What did the yield curve do last week? Well, you can see that most of the damage was 2s, 3s, 5s. 25, what's that? 25 basis points, 27 basis points, and 20 basis points at the back end. Now, the problem is that the yield curve is getting to such inverted levels that basically it's as inverted as it's ever been, apart from a very short period of time in the very late 70s and early 80s, basically the Saturday Night Massacre. So it's very difficult for it to get and stay more inverted. But it will do. If CPI is hot, i.e. you have a higher than expected number, all the damage is going to be in the 2s, 3s, 5s area. Possibly this dip gets taken out and you get this kind of curve. But certainly 2s will suffer. 3s and 5s arguably could suffer more as the market goes for this kind of shape. 30s, they will go up, but they'll go up least. The question becomes how far then the yield curve can flatten out and how far can the twos go up. They certainly can go up higher than the all-time highs. Sorry, not all-time, this cycle highs. And then we see. I don't think, as I said earlier, that this scenario, all we're doing, let's put it more precisely, is assigning probabilities to these scenarios. So if we assign a higher probability to the no landing scenario, as I call it, that doesn't mean that the probability goes to 100% and stays there. It'll fluctuate with the subsequent data. And again, nothing is going to get decided by one CPI number. So let's have a look at all the individual tenures and try to understand to what yield levels we're going to. 3 months bills. This is still a trend. We have not turned the central moving average once since we were down here. So the market is telling you that we are still looking for higher yields, whether the terminal rate is 490 or 550 or whatever this is, 538. This goes back many, many years, and I'll show you where, this is on a monthly, this is what we're looking for, right? Could we go here and stay there for a while? Absolutely. And this is probably the highest probability scenario at the moment, and the one that makes most sense. That basically on a monthly basis we go and we trade this terminal rate around 5 to 535. And then, to me, you get one of these periods after that. Because, as I said, the no landing scenario inevitably leads to the hard landing scenario at some stage. But that, we don't need to think about that now. We just need to think about where we're going in next week, and we trade it week by week. Anybody who tells you that they know what's going to happen to the economy is talking utter bullshit. They have no more clue than, if a coin is going to land heads or tails. Simple as that. Anybody who tells you they know what's going to happen to the economy is a complete bullshitter. So, 1 year, still, we have not turned the moving averages down. We're still looking for higher levels. And let's start looking at the interesting stuff. Okay, so 2 year. To me, it's very, very unlikely that the market can make a big move one way when we are already at the Bollinger Bands. It would have to be a very, very extreme number to justify going through the Bollingers and staying there. Can it happen? Of course it can happen. Do you want to bet against it? Not before the number, but you just have to understand that with this technical setup, the likelihood that we go to 475 on Tuesday with CPI and stay there depends entirely on a very hot number. I'm not going to say we're not going to get it. How the hell would I know what we're going to get? I'm just saying be careful. To me, the risk reward of being short bonds when the technical setup looks like this, it's not good. And therefore I don't bet on it. So if gun to head, I would have to bet that we go down in yield and that we get a very cool CPI number, gun to head. But I'm not a gambler. I am a guy who makes money or tries to enter the highest probability setup to make money from the highest probability. So I would definitely not be short of bonds going into this number because I don't see the technical setup or the probabilities being in my favor. But it's all the same everywhere. 3s, 5s, 10s, and even 30s, we are all at or above the daily Bollinger Band. Again, does that mean necessarily that we go back down? No, it just means that to go worse and stay worse, we need a very, very extreme number. Nothing more than that. We might easily get it. Now, let's have a look at the yield curves and why they find it very hard to stay as inverted as they are. It takes time, okay? We are basically trending up, but we are not in a very, how shall I put it? We are not in a strong trend. We're in a very weak trend. Why? Let's have a look at the monthlies. This is basically as inverted as the yield curves have been. This data doesn't go back, but it was more inverted back in the 1979, 1981 time, but not by very, very much. So we are getting to the most inverted of all time in something like 2s, 10s, and that is difficult to maintain, right? The market doesn't really like it. If we go at 5s, 30s, we are getting towards the most inverted it's ever been. And for 5s, 30s to be that inverted, it basically says that the market is afraid that the Fed would have to keep rates very, very high for a relatively high or real rates high for a long period of time to tame the economy. It's unlikely now that we go, to me, it's unlikely that we go much beyond 40, this 43 level. But if we do, we definitely have the possibility to go to 60. And I think that this is what's most likely to change next week, is the total shape of the yield curve. Because if the number is hot, they are going to find it very difficult to maintain the terminal rate they have at the moment, say just above 5%, and they're going to have to, the market is going to push 5.25%, 5.5%. Again, that is not going to be maintained forever, but certainly the probabilities are that we start trading towards those numbers, and that's going to affect the short end most and the long end least. So I would expect really it to be reflected more in the 2s, 10s and 5s, 30s than in the absolute level of where we are. So last word of warning about this number. If it's hot, 2s probably won't trade. First trade is going to be around this 475, 471 to 475 area. 2s and 3s are going to be the ones most under pressure. 3s are going to take out this 427 area, and then you're looking for 442 very, very quickly. You have to concentrate on 2s and 3s because a hot number increases, as I showed you, the probability of this no landing. And that is the area really that is going to suffer most. You're talking about I know that people have transitioned from euro dollars to the short, the stairs. That is the area of late 2023, mid 2024 is the one that's going to really get hit. And that's going to have most effect on 2s and 3s and the repricing of 2s and 3s. I don't think that bonds are going to dislike it very much, because the long bond, because it just means that the Fed goes even tighter. And the long bonds are really going to quite like the fact that the Fed is going to have to go even tighter, and that it actually, to me, it brings the hard landing scenario further forward. So if you have a look at, if you remember the chart that I just showed you with the slide rather, with the three possibilities, yes, they might price up the scenario of no landing, but they also will price up the scenario of a hard landing after that. And the scenario of the soft landing is the one that's going to get sold the most, i.e. it's going to be like a butterfly trade. They're going to buy the hard landing, they're going to buy the no landing, and they're going to sell the soft landing. Germany is also showing absolutely no signs of turning. Schatz, I mean, was it wrong to take profits here on Friday? I don't think so. I think we're playing the odds, right? We got out. We got into the position right here, and we're getting out of the position right there. I don't see that that is wrong. Can he go a lot further? Yeah, and then we'll jump all over it again. But I don't think that this is wrong at the moment to take profits and see what happens. Because on Tuesday, the CPI is good. It's going to probably have, trade down here, and we get back on board. As simple as that. There is absolutely no sign in any of these charts, whether they be 5s or 10s, that we are changing any kind of trend. We're just in a technical market. And when we get to the upper level of the Bollinger Bands, we get out because we are in a technical market. But if you look at the 1 year, there is no change in trend here whatsoever. Forget these lines, they're just misprints. It's not a very good yield capturing system. But there is absolutely no reason to think that we are changing our trend, which basically means every time the yield dips and the futures rally, we get back in. Let's have a look at what the what it's doing against the US. It's trading in a range, i.e. it's contained. So to me, the Germany is still going to be at these levels, is going to be a sell against the US, which also actually tells me that the number on Tuesday is more likely to be a non-event than anything else. That's what the technicals would tell you. Naturally, the technicals have no more idea than I do of what the number will be. But the market is guessing that the number actually is going to be more or less in line, and the moves are not going to be that dramatic in the bond market. That's what the market is guessing. It could be wrong, but to me, being flat going into this number is a no-brainer in terms of risk-reward because of the technical setup that we're in at the moment. And also the fact that on, say the number is cool, on any backup in yields, the thing that you want to hit, i.e. be short of, is Germany at the short end once again. Because then you probably get the short end going, from here back down towards 152, as the US takes out some of the bearishness. But why should Germany take out much bearishness? No reason, right? So to me, every time Germany gets better against the US, you hit it for these levels again. And if you're looking for tens, this kind of level again is going to be a gift. Around 148, between 148 and 152, you do half at 148, half at 152, and you look for it to come back down to 123. I think it's really as simple as that. DXY, I've got very little to say. A, because I'm not a foreign exchange trader, and B, because to me, it would make sense that we top out somewhere around this kind of level, 104 something, high 104s. I don't see the impulsion or the fundamental reason for it to go much higher than that. I think leaving an offer for anything you bought around this 104.70 to 80, 90 level is good risk reward. I think that it's not going to go much through that. And what would that imply? That would imply a number which is more or less in line, right? A CPI number which is more or less in line with market expectations and which does not have huge implications for anything. It's really as simple as that. If we have a look at Euro USD, you can see where it traded back down towards this 105 something area. That would be a very decent level to get out of any shorts established around the 110 area and get out and basically, look for a sideways action, which again would confirm to me my view that any jump in the relationship between the US and Germany around that 150 on tens is the right short. So that's how I am looking at it. You can see how oversold on the dailies it is. So the risk reward is poor for looking for much higher dollar at the moment, which again tells you that the CPI is probably a complete non-event. So there you have it. I think we are doing the right thing by being flat in bonds going into it. And I think the highest probability trade after CPI is one in which they try to reprice one of the three scenarios, but not violently. Gold, what to say there, basically didn't move all week. That's because it got down to the bottom of the Bollinger Band and all it did was go sideways, open up, started the Bollingers. So basically it's opening up its way to 108.30. I would give it a go at buying it at 108.30. Okay, I'm putting in some bids at 108.30. Really looking for not much more than a bounce back up to this 108.90 area, but still probably worth having, right? There's going to be decent support down here. I don't see that again, this would suggest that we're not going to move very much in anything, but you can see that this area here, whether it's 108.30, 108.40, 108.20, whatever it is very, very good support. And I very much doubt that unless we get a ridiculous number out of line from expectations, that we can do much worse than that. So this area down here, I think, is going to be a buy on Tuesday. Say it's they first interpret it as a strongish number. They sell bonds, they sell gold. It gets down to here and bounces straight back up. That's what I think is the highest odds trade here. Oil is basically telling me that it doesn't like it below 75. It keeps on bouncing on the monthlies between the 75 and 69 area. It doesn't like it below 75. It's still in a daily downtrend. Look at a 200-day moving average rolling over, but it's a highly technical market now, right? It's not a trending market. It's a sideways, highly technical market. And if we look at DBC, I don't like the fact that this needs to come down a bit, i.e. commodities, i.e. DBC needs to outperform gold for a bit and basically get us to an area of support around here and then turn the moving averages and start going up, i.e. then you start preferring gold to DBC again. I'm completely neutral. It's where's this gonna go? I have no idea. It might go a couple of percentage up and a couple of percentage down, but it's not a trending market. It's not. It's a highly technical market. It's not giving you any reliable, longer term, strong trend signals. And if that is the case, okay, and if DBC, which is 60% oil, whatever it is not trending, why should bonds trend? Okay, and that is the bit that I don't understand with people who are looking for extreme behavior by the economy. If oil is stable, if all we're really arguing about is a terminal rate, or is it going to be 25 basis point higher or lower, we can't really be arguing whether it's going to be in the sixes or sevens, not until there is a reason for it. I just don't see why. I can understand that inflation remains sticky and that it doesn't go any lower than 3.25, 3.5, or something like that, and then the Fed gives it the final coup de grace by hiking. But it's not going to happen tomorrow, and it's not going to happen because of CPI. It's not even going to happen at the meeting in March. It's going to happen in, I don't know, over the summer or in the autumn of this year. That's why I'm saying nothing is going to get resolved by CPI, and nothing is going to get resolved between the three scenarios of hard landing, no landing, and a smooth landing, a soft landing, until much later this year, which means we have a lot of up and down trading, and a lot of confusion between now and then. It's a technical market. Trade the technicals. Do not be tempted to short at the bottom of the Bollinger Bands, because we're not in this period. We're not in a trend. Yes, I just can't get too bearish here. If we look at what again, I'll mention the scenarios, the highest probability is that we continue to bid up or not sell, let's put it that way, not sell violently the no landing scenario. That to me is the highest probability, i.e. the economy continues to chug along and inflation remains contained but sticky. And that favors equities over bonds. And, unless bonds go down very far, then equities don't go down very much. And you get this kind of relative stability and trading well within Bollinger Bands and not being extreme. If we look at the weekly, would a couple of weeks of touching 41.64 and coming back off it and possibly going up to 42.47 and coming back off be something that should be unexpected by the market? I don't think so. I really don't think so. I think we are in tighter and tighter ranges. And that is what low volatility tells you, that we are in tighter and tighter ranges as the market takes a long time to actually finally decide and get a trend as to which of the three possibilities we are in. Remember this chart. I'm just trying to marry the fundamentals and the technicals together and come to the highest probability. The highest probability here is that we trade around this times 18 line for a long time, i.e. up a bit, down, back down to it, up a bit, back down to it. Why unless bonds are going to make a big move to the upside in yield now, how are equities going to get much away from the times 18? Because, okay, so if bonds make a big move up, that to me increases the probability of a hard landing. And equities are not going to like it. And high duration equities should certainly come down, i.e. the Nasdaq. But I don't think that that is the most likely outcome. Certainly not what the technicals are saying is possible at the moment, and certainly not what the fundamentals are telling you either. A period of going sideways, up and down within a, say, 5% range for weeks is much likelier than a big trend either up or down, isn't it? Let's use our brains. Let's try to connect the dots. That's what the market is telling you. All they're doing is increasing the probabilities of one of the scenarios by 5-10%, then retracing it, then getting the other scenario, as a piece of data comes out and the other scenario starts looking more likely. But it's a question of degrees of likelihood as opposed to resolution. If the market thought it was going to get resolution from a number, would VIX be at 20? No, absolutely not. Because, all you do is you go in and you buy whichever side is your favorite trade and you're going to have a strong trend. Well, the market is telling you you're not going to get strong trends. And I'm not going to fight it. I think we're still in a technical market. I think everything I've told you about the fundamentals is a question of degree as opposed to a question of resolution. And therefore, I'm going to follow the technicals and the highest probability trade that comes out of the technicals. To me, the VIX is telling me not to expect too much on Tuesday. End of story. The Dow fascinates me. I mean, it's been in a very tight range for a very long time. It still hasn't turned the 200-day moving average, but it's in the process thereof. I think dips in the Dow are going to be an interesting buy. Okay, so anything below 33,200, I'm going to be shipping in, as they say. So I'm going to put another line in there, and whatever that kind of level is, yeah, okay, let's go down a little bit. There you are. 33,200 all the way down. This box here, I'm going to be a buyer of. Longer term options. I quite like these defensive sectors. I don't think that we're going to have big moves either way, but down here I think the Dow is interesting, much more interesting to me than the SPX or the Nasdaq. The Dow I like. It's beginning to turn the 200-day moving average. Might take several months, but it's probably the one that has got the highest risk reward for the long term. One final word about the risk indicators. None of the risk indicators that I look at, and I look at quite a few apart from these, which you can set up yourselves, is in a negative phase, which tells me that the dips in the SPX are going to be contained and they're going to be reasonable and not to get too overexcited on selling a dip. I'd much rather buy a dip than sell a dip still. And it's been the same since the beginning of the year, and it's unlikely to change for quite some time. There is nothing especially bearish that I'm looking at. To cut a long story short, for things to change dramatically, you need dramatically different data. And I don't think that we're going to get it. Can we get it on Tuesday? Of course we can. But the odds are against it. That's all I'm trying to say to you. The odds that we get something dramatic on Tuesday are against it. It'll probably be more of the same, and then the trend continues. people buy more equities than they buy bonds. Bonds do slightly better, but equities probably do better than the bonds do. I think it's going to be a steady as she goes story for quite some time. I've updated these numbers, not many and not very much. I think gold around 1830 is worth a long. And if should we get this kind of 39.74 level in SPX, I'll be a big buyer. But also, I will be a buyer of the Dow, as I showed you. I think that the defensive sector is unlikely to go very much lower, which tells me that everything is going to be stable. In bonds, the only thing I think can change is the yield curve, i.e. can move 5-10 basis points. I think the absolute levels of bonds are unlikely to change very much given the technical situation that we're in. Thank you very much indeed. Naturally, tweet you on Monday and we'll be ready for Tuesday. And as I've shown you, I doubt that we're going to get any resolution. So do not act on the first price that you see after the number.